Hi, I'm Joe McGuane, and in this section of Investing 101, we'll be covering an alternative asset class, hedge funds. In this presentation, we'll go over what is a hedge fund, different types of hedge fund strategies, risk associated with hedge funds, structures of hedge funds, fees and liquidity associated with hedge funds, and a return analysis of hedge fund performance over time. The first hedge fund in the United States was started in 1949 by Alfred Winslow Jones, who invested both long and short in publicly traded stocks in order to limit market risk and generate positive returns in any market environment. Total assets in the hedge fund industry are over $3.2 trillion, with more than 8,000 hedge funds in operation today. Hedge funds are a privately organized investment vehicle that manages a concentrated portfolio of public and private securities and derivative instruments on those securities that can invest both long and short and can apply leverage. You can see here some of the common characteristics of hedge funds. They have the ability to short across equity and bonds. Funds have the ability to apply leverage. Most are structured as a partnership and have liquidity restrictions, all of which we will touch on later in this presentation. This slide touches on the popular hedge fund strategies that are in use today. Long short equity go long equities they feel that are undervalued and go short equities that are overvalued. Long short credit funds buy bonds they believe are undervalued and sell bonds that are overvalued. Multi-strategy managers have multiple portfolio managers managing a portion of the fund focused on a specific sub-strategy. Global macro makes directional bets across equities, fixed income, currencies, and commodities. There are many benefits for including hedge funds in a diversified portfolio. Some of the key benefits are their low correlation to traditional asset classes, providing investors with both attractive risk-adjusted returns and added diversification. The hedge fund structure gives managers more freedom in their investment mandates, allowing to invest in a wider array of assets than many traditional managers. Managers are able to invest in less liquid securities that are not possible for traditional asset managers who need to provide daily liquidity to their investors. The following risks should be considered by clients before making an investment in hedge funds. Fees are higher than traditional investment managers. Liquidity constraints limit a client's ability to rebalance at times due to lockups. Business risks tend to be headline risk when a fund closes unexpectedly or enters into a controversial position. Leverage is used by managers to magnify returns by investing over 100% of partner capital. Investors typically have less transparency into the underlying assets that the funds are invested in. Hedge funds are typically set up as a limited partnership or limited liability company, where there is a general partner and a number of limited partners. Fees are one area clients must consider before investing in a hedge fund, as they charge both a management and performance fee. Management fee is a fixed annual charge as a percentage of assets under management. Performance fees are only charged on new profits made in the fund. This fee summary should give clients a good idea on typical fees we see from hedge fund managers. An operating fee are expenses associated with executing day-to-day management and operation of the investment strategy. Most hedge funds we come across require new capital to be locked up for a certain period of time. Investors are unable to withdraw their capital over that time period. Hedge funds only allow investors to withdraw capital periodically, typically monthly, quarterly, or annually, after notifying the manager ahead of time. We will now touch on performance for hedge funds over time. Over long periods of time, hedge funds have produced returns equal to or superior to traditional asset classes. Hedge funds have outperformed both the Barclays Agg and the MSCI ACWI. Since 2000, the HFRI Fund Weighted Index has kept up with the S&P 500, the Barclays Agg, the MSCI ACWI, but has underperformed the Russell 2000 going back to 2000. During periods of large drawdowns in the equity markets, hedge funds have typically experienced significantly smaller losses. During periods of stress in the equity markets, the HFRI Fund Weighted Index consistently outperforms the other major equity indices. Historically, hedge funds have exhibited low correlation to traditional asset classes. Adding asset classes with positive expected returns and low correlation to the existing assets in the portfolio can help increase the overall return of the portfolio while lowering the risk. Hedge funds have historically exhibited a much lower dispersion of returns than both domestic and international equities. This low dispersion of returns means hedge funds tend to be less volatile and can help to lower the overall risk of a portfolio. Lower dispersion can also add important diversification benefits, particularly for investors that rebalance their portfolios regularly. Hedge funds' lower risk and attractive return profile leads to superior risk-adjusted returns. Compared to traditional asset classes, the Sharpe ratio for hedge funds is significantly higher due to similar returns with lower levels of risk. This concludes our discussion on hedge funds. Thank you for watching and have a great day.